Hi, this is Randy Finney with Right Side of the Chart, and this is a mid-session update for Thursday, October 26, 2023. It's 11:08 p.m. I'm sorry, a.m. Eastern Time. I'm starting the video, and fortunately, as I said, I got a post out to you. I was able to appointment I had today went a lot shorter than I thought it would, so that's good. Back at the desk, and we'll see if it's just in time. I'm going to go over the key levels, share my thoughts. And again, what I try to do is get out significant technical developments before they even happen. So that way, if they do happen, then you don't have to wait for a post from me. And again, this is my take on it, and you have your own, and use that with whoever else you listen to or get your analysis from. But all right, I'm gonna just dive right in here. This is SPY, the S&P 500 tracking ETF. We have this primary trend line here off the lows. That's the October low, the low in the market right there, which, as highlighted recently, broke down, back tested. Been overall clearly bearish on the market and mostly short. Gaming some bounces here and there as an active trader, but the big picture is I still maintain and have never waffled on the fact this is most likely or was a bear market rally from mid-October of 2022 into the July highs, and that this is the beginning of a new downtrend. The S&P 500, like the NASDAQ, is at support. This is why I'm doing this video. We're at support. I'll tell you, there's just a lot, but there's some like yin yang forces going on, in my thought process with technical analysis, because we've taken out. I'll get to QQQ in a second, but we've taken out some of the key support levels, and I've continued to see those yellow and even red flags build that I've talked about. The key stocks that I follow, things from UPS, FedEx to Visa, MasterCard, Paychex, all these other U.S. Treasury bonds. Okay, so there's that, a little henny penny, the sky is falling thing. However, there's, like I said, I can, let's just look at the technicals, all right? So fundamentals aren't great, at least the things I'm watching. There's a dichotomy. You turn on CNBC, you watch these economic reports. GDP today, came out stronger than expected. So, if you're going off those things, many of which are dated. GDP, for example, that's a quarterly report. By the time the quarter's over, there's 1 month lag till they even report it. Then, almost always and very often, GDP is revised after that in hindsight. So it's, half the time you don't know we're in a recession till long before, till after the dang thing's over due to the revisions from the BLS and all that. So anyways, just keep that in mind. Now, okay, back to the levels. So what I can tell you definitively is SPY is at a good support level. I've had this line here forever and a day, 416.42. I think it's a very key level. Why? Well, there was a lot of reactions during back here. It was big support. You had our first big bear market rally off there. Then you took it out. Once it was taken out clearly, it was resistance. You had a little brief pop. There was a failed breakout, but there's been, especially recently, a lot of reactions in this trading range. This was the most significant trading range of 2023 right here. We had some consolidation. We were pushing along those previous highs, and then NASDAQ 100. That's when really NVIDIA kicked it off, I believe, with the earnings at that point, and it just brought everything up with, the collective belief that AI is going to change the world. It's kind of the dot-com bubble all over again, to a little bit lesser extent. I know that AI has its merits, and dot-com bubble, a lot of those companies had no business model, no prospects. But either way, technically speaking, let me get back. I'm rambling. Key technical level. We are below the 200 days on SPY, but remember, SPY, even though it's more indicative of the U.S. economy, having financials and other things that the NASDAQ 100 doesn't, and being more diversified, it's not really what matters anymore. What matters are those big tech stocks. So you're looking at QQQ, get a more concentrated view of the indexes. So SPY, what I'm getting at here, is pierced the 200s before, both on the upside and downside since this bear market started. I'm referring to the blue and red lines right here. These are the 200 simple and exponential. So the fact SPY is below the 200s, undercut it, it's kind of what it does. Let's now talk more about the NASDAQ 100. But before I get away from it, again, I wanted to say at support, with positive divergences. Again, in a bear market, those divergences can get chewed up. You got to take them with a more of a grain of salt than you do in a bull market. But they are worth noting because, especially on the daily time frame, if they play out, meaning we get the PPO curls up and makes a bullish cross, and we start to hold this support and rally off it, then typically you're not talking a day trade, a little short-term 2-3 day swing trade like I've been highlighting on the 5 and 15-minute charts lately. You're talking a position that's going to last for, even in a bear market, many weeks, maybe even months. So let's watch it. On the flip side, let me go over to QQQ now. We are at, I just made a reply to somebody that asked my opinion on Microsoft. You can see that it was under the last post I made, or the second to last post. Asking about Microsoft. I said, I don't have much of an opinion on Microsoft other than long term. I still maintain Microsoft and everything tech and Big Mag 7 are going a whole lot lower. We're talking well down double digits, can probably take out these lows. That's been my view and still is. Near term, Microsoft, I don't see enough in the charts to have a strong conviction on it. The ones that I do have, I showed you, and I'll get to in a second. Alphabet, right at support today. We have Amazon at support right now. I'm going to get to that in a second, but they report tonight. And so the takeaway that I said in there is, look, near term, if you ask me, Microsoft probably going to go up and down with QQQ, wherever that goes. And that's what we're going to look at right now and try to determine where's QQQ going. You're going to be a lot safer in this environment for the most part trading QQQ versus an individual company unless they've reported. That's why I threw Alphabet out to you as a potential balanced trade idea, because their earnings are out of the way, so we don't have to worry about what happened to them the other day, being caught on the wrong side of that after they reported. Okay, so let's zoom in. Let's talk NASDAQ 100. So I've been highlighting for months now this 354, I'm sorry, 354, I have it at 354.70, key support, saying we'd have to take out that previous reaction low, take it out on a daily closing basis. It was support. And since I was saying that here before we even came down to it, the fact we tested it for almost 2 straight weeks by far further validates that level. It was a reaction low. You can always look at that trade, distinct reactions like that, that are, separated on both sides. Traders will often focus on, but the fact you had numerous other reactions further solidifies it and makes it a more significant level. And so that now broke. It broke yesterday. We had a solid close. Again, I always say, if you have to squint and look, do we close above it, below it? Then you give the benefit of the doubt that it didn't break down. You didn't have to squint yesterday. We closed down below it and we followed through today. But as I said, we have the key 200-day moving averages, turn off all the lines, which tend to work very well for support. And that's the blue and the red line here. The blue is your simple, the red's the exponential. And they tend to do a very good job of acting as resistance when you're below them. So you can, in a bear market rally, you can short rallies into it, and support in a bull trend. So we took them out here. We back tested them successfully right here, the 200 simple, and now we're at the exponential. And as I say, sometimes the exponential does a trick, sometimes a simple. Half the traders out there use simple moving averages, the other half use exponentials. Therefore, I use them both because, I don't know who's going to have a bigger subset of buyers when either one's hit. So I keep them both on my radar. And so that's it. And this is the first pullback to the 200 exponential, first test of it since all the way back here after we broke out above it. So that's something worth noting. So again, I'm giving you kind of glass half empty, glass half full. The market has, and that reply to somebody I just mentioned on the homepage, I said, look, it's like, imagine your car. If you're a gearhead, cars nowadays, I don't even think they definitely don't have the analog, most of them don't have the analog tachometers anymore. And those that do, they don't have a red line because the computers are going to, govern the car anyways and not let you blow the engine. But back in the old days, your old big block V8s, whatever you're driving, you had a red line zone in the tachometer, and it would go up, and you get closer to the end of that red line, and you're risking, and the longer you run it there, the bigger chance the engine's going to blow. And that's kind of what's happening now. We've been pushing, but and I said maybe the big slide has started. And I mentioned a couple weeks ago, I think the hammer was about to come down the market. It's a pretty good hammer. It's not a sledgehammer yet, maybe more of a hammer tap, but a pretty nice down in the last week or so. But here's where I'm at right now. It can go either way. I gave you a trade idea to go long because QQQ hit. This is a support level I've had here for forever and a day. There's been numerous short entries on QQQ as a swing or trend trade. I posted a lot of counter trend trades, but we've been zigzagging down. And no matter who you are and what your views are, you cannot argue that the QQQ is not, and the market's not in a downtrend since it peaked back in July. It's in a near to intermediate term downtrend. It's really been months now. Within this larger uptrend off the mid-October lows, and now we're at support. So all I can do in trading at times, especially when I have mixed thoughts like this, number one, you have three choices: do nothing, go to cash, and sit it out. Because what I can tell you, this thing's, we're going to see some volatility over the next week or so. I can't rule out a market crash, but I'm going to tell you right now, I'm not leaning that way. And I went long and had some longs, and I added longs today on this drop here when I got back home for the reasons I just showed you. Alphabet being at support, QQQ at support, and don't follow me. It's not a follow me site. We could just break down. If we do, you have then T3 and the 200 simple below, and ultimately, I'm thinking these are just near term. Intermediate term targets down here, and I still think they'll be hit, and ultimately we go down a lot lower. I just suspect Amazon's tonight, and I'll tell you what, and again, this is the funny thing, and I've said this time and time again, hopefully you've now learned a valuable lesson. If you're kind of new to this game, don't listen to the bobbleheads on TV. It's not about what a company reports. From what I can gather, and I swear I've only scanned the headlines, and briefly I'll turn CNBC or Bloomberg on when earnings are coming out just to hear how they were. So what I'm gathering is everyone had great earnings, even Alphabet. They had one miss. Everyone beat expectations. So far, I'm talking the big tech, Meta, and all that. Alphabet had just a slight miss on their cloud numbers, I think it was, but everything else check. YouTube, all their other services. Doing well, and you can see what happened to Alphabet. So that's the takeaway. I always said it's not what the earnings are, it's what the market's reaction. So it shows you right now there's obviously more sellers on the sideline. In a different market environment, they would have exploded Alphabet and Meta and who else reported? Microsoft. Well, Microsoft did pop, but a lot of that's been faded. So I'm just trying to show you that gives me, it's a tell. I'm a poker player, love poker. It's your game, and I use a lot of analogies. It's just like, if you know your other opponents well, if you're good enough and you played long enough, you look for tells instead of just focusing on your own card. You're watching the other players, you're watching how they bet, and little nuances that they do, little quirks they might have to pick up on a tell whether they're bluffing or not. And so this is the market's kind of showing us its cards now and saying, hey, look, there's not a lot of buyers, and the buyers have dried up. And even on good earnings reports, these stocks are getting sold down, and that's bearish. That shows you that the sentiment, the trend has changed, because back here, it didn't matter. Good news was good news, and bad news was bad news. Yeah, would shrug it off. They would spin any kind of news, and whether it was economic data, that the Fed is going to be finished or not finished, it didn't matter. It was just, you're in a trend where, again, the news flow, the narrative gets changed, and then all of a sudden, like I said, then bad news is bad news, and even good news can be bad news for the market. So, all right. So we're back to those lows. Right now, as I'm doing this, we're right back. I'm going to go to QQQ, the low of the day. So this is where the market needs to either giddy up. We're on the 200-day moving average. Let me get to the rest of the stuff, and I'll wrap this video up. We still have positive divergence. I think now that we've taken out my 354.70, I'm not gonna eliminate this. I told you I would. I'll just leave it there for now. I think the odds are very low. I think at best, I gave you a scenario yesterday. I think at the end of the day, let me find a clean board here. Let me go to the 60-minute chart. Let's do that. So this is a 60 right here on QQQ, 60-minute chart. And so our divergences are really stretching the limits here. I have to take a line like this, put it down, we have about equal lows in the PPO. Same thing, slightly higher lows in the RSI down here. So we technically still have, by the skin of our teeth, that positive divergence. But again, we've had divergence, and this is kind of a bear market trait where these divergences just don't play out anymore like they do in a bull trend. You can get a divergent low in a bull trend, you go up. Or even early on in a correction, once the turn comes, you had a divergent low there. It was good for a nice tradable rally. You had another divergent low here. It was good for a nice tradable rally. $1 million question, will they take this one out? So just pure price perspective, again, we're below that red line. I put a lot of weighting into it before. I've been talking about it for weeks. So I can't get very bullish, nor can I pull off the table the risk of just an outright crash. Why? Yeah, we still have Amazon coming up, and then Apple next week, and they could pull a rabbit out of their hat and save the market. But what happens is, this is why crashes and swift drops, and why I like to trade them. And you got to just be quick if you're getting out, like I did, reversing them in my active trading account, because what happens is, almost all points in time, there are a lot more bullish and long side traders out there at any point in time, really. Most people are inherently bullish. Believe me, I used to be an investment professional, former stockbroker, and all they pump, to you, and they bring in training and speakers, that the stock market always goes up. Just buy more. You'll always be bailed out over time. You're going to make money. And so I get that. And at most points in time, it does. However, it's when you start to go down, there's that certain threshold, and that's what I've been trying to identify lately, where it's kind of the red zone that I've been talking about, where if stocks go down, then all of a sudden, boom, you hit these big sell programs, big hedge funds, big pension funds. Think of pension funds that cannot sit there. They cannot afford to sit there and ride down a 55% bear market like we had in 2007 to 2009, 85% drop in the NASDAQ in 2000 after the dot-com bubble popped into the 2002 lows, I think it was. They cannot afford it. So what happens is they've got to start hedging up or selling stocks. And so then you get this domino effect. And when the big institutions all start dumping, and like I said, you have stop loss orders on individual retail investors as well, that's where you can get those quick swoons down. So I think we may be on the verge of it. I may flip back into being short very soon in my active trading account. I'm not liking the fact now. We're keep testing this level, but it's still there, that we're making a new low for the day as I'm doing this video. But let me show you the rest of them, then I'll get the video out to you guys. So Apple, again, none of these lines have changed recently. I've had two purple levels on all the Mag 7 stocks that are key levels that I think, if and when taken out, will open the door to a much bigger move down. Apple has now taken out the 170.37-ish purple line, which was support. It also, in one fell swoop today, yesterday took out the 200 simple, and today the 200, exponential, the red line. Today we're clearly down below the 200 simple. So below both 200-day moving averages, and that's no bueno from a technical perspective. But that's my last level there. That's kind of the line in the sand. So again, Apple's pushing the red line. They don't report to next week, but the market right now isn't waiting to find out. You can see kind of where things are going. And again, Apple's been a short since here. I referred to this like so many as a beautiful textbook bearish rising wedge with breakdown, back test, and then we broke the minor trend line, and that was it. So it was a swing, tuck it away short. It's in play now, and it's still going, and I think it still has a lot more downside to go. So there is that kind of, all right, forget about the 15-minute charts, but you do have support here, and the day isn't over. You also have positive divergence, which again isn't the be-all end-all, because that can get taken out in bear markets, but it's there. And so you can't kind of load the boat short and throw away the key on Apple, because if it can rally up here, keep these divergences intact, especially if it can rally back and regain these 200-day moving averages, because sometimes you get these brief pops above or below them only to see it fail. So we could recover, but it's got to do it soon. That's what I'm kind of saying here, is we're pushing the red line on the tachometer. And if if they don't back off soon, meaning if the market can't rally soon, some of these big fangs get back and defend these levels, then to me it looks like it's going to be lights out. Microsoft, that's like I said, I look at this chart, it's a no man's land. I don't have any support. We popped above here. That was a false breakout. I can tell you that's bearish. In fact, we popped above 340.38 and then failed it. So it means we're probably going lower, but there's a gap backfill right here. They'll probably step in and buy it. So I still think we're going to get a bounce today is where I'm leaning towards. And maybe by the end of this video, I'll tell you otherwise, but I doubt that. I think I'll see a little more than just undercutting today's lows. Here's why. Let's go to the next one. Alphabet. This is a target, a support resistance zone I've had forever and a day. It is a big level in my opinion. Why? Well, it was the top of this trading range back here, all the way back in the previous bear or the first leg down, 2022. This range here. Bring that over. Then we had another trading range there. It was the bottom of that range. Fell below it. Put in a little range there. Kept testing the top. So I can see here, carry that line over, lots of reactions through there. Plus, turn off all the lines. You got your 200-day simple moving average right here. So you rallied up, couldn't take it out there. Rallied, finally took it out, back tested the simple, off to the races. Look at that perfect back test right there. This is where the traders will often come in. And sometimes, again, it's the 200 exponential, which is the red line. Sometimes it's a simple, but that's it. So this is a level where if there's any buyers out there, any bulls that think this market's going, or even just traders like me that just want a game of bounce, that come in and buy the 200. And again, stops, just like I said earlier, don't get married to it. Put your stop is going to be commensurate with where you think this stock can go. I give you a bounce target. You can see it there. It was about 127.15, give or take. It's that purple line, which remember on the flip side, that was a level that I said would be bearish if taken out. So like I said, there's a lot there for bulls and bears alike. But, you also look at it this way. Alphabet's earnings, from what I can gather, were not that bad at all. And then again, it's hindsight looking stuff. Earnings too, like GDP, are quarterly, and then it takes a month before the quarter's over to they even get them out. So you're looking in the rearview mirror if you're trying to navigate this market with fundamental analysis, because you're just using dated information in most cases. But that's a 14% drop down to the 200. They're going to probably come in and buy this thing here today. And if they don't, well, my next support and target is 115.37, and I have the 200 simple down there. So they don't buy it here, they'll probably buy it there. So if you want to know what I think your downside is, other than a market crash, which I don't think is going to happen before Apple reports next week, is another 5% downside. So you could take it, even use a 1-1 RR. You're going to make, roughly 5% on the pop if you get it, if it pops up, or you lose 5%. There's no guarantees. Or, better, I think, give it a somewhat tight stop under there. That gives you a better RR. If you took it at today's lows, that's where I threw it out to you at. We're right down at the bottom of that trading range. You can give yourself a 1-2% stop loss, and you're going to make 5% if right. That's a decent trade, and maybe more. If some of these charts firm up, there's a big old gap it might want to backfill there. So if you want a second potential target, there it is right there, about 133.66. The same support levels I had on the way down act as resistance levels on the way up. Amazon, wanted to get to this one. They report tonight. I like to play the game of, stock clearly bullish or bearish. This is actually a nice looking setup. So this could turn the market here. Again, bigger picture with huge, massive, much larger negative divergence leading into the highs. This was a big old fat divergence building for quite some time. However, this is one of the world's largest companies, one of the most beloved, one of the most profitable. It's Amazon. It's dropped 20% or so in just the past 2 months, and it's now down to the primary bull market uptrend line off the lows. That's the January lows right there. We were long Amazon. It was one of my favorite right here coming out of the gates in the first of the year, and that's the trend line off that low when it bottomed. So it's not been validated yet. I'll say that. I'd like to see 3 reaction, but I think we'll get a reaction here Because not only that, you also have just below it the 200. See that blue line? There's the 200 simple. So I see minimal downside. If it wasn't reporting tonight, I'd buy it. And you know what? I might throw some Vegas money before the close today, especially if we hold up right here. Like I said, I already took Alphabet today, added on to the Qs. I told you I took the semis yesterday. I think there's a bounce there. Again, so I'm trying to thread the needle here, guys, and sometimes it works, sometimes it doesn't. And you know me, I'll flip on a dime if I think it's time to get short again, but probably won't be today. Let's see how today goes. At most, I might just stop out and go to cash if something happens. It looks like the market's going to crash, but I don't think it's here yet. I think it's coming soon, but not yet. So, and again, Amazon, man, if it can, turn up here and give another reaction off this trend line and rally up, you're going to put in a divergent low. Then you have this, bullish falling wedge. You could actually get we could see some long side trades here that could last weeks or months. So I could change my tune shortly. And, as far as intermediate outlook, I'm talking weeks to months. But let's see how they report, or how the market treats them after they report tonight, how they trade tomorrow. Don't read too much into the after hours move, especially the initial reaction right when they report. Wait for the call, wait for the the big boys to step on the field the next day when the liquidity is there in the regular session, and know that it's going to be Friday tomorrow. And so just keep that in mind too as you're entering or taking on any new swing positions, that whatever you take between now and 4 p.m. tomorrow, you're going to be sitting on that over the weekend with 2 days of overnight risk. You've got crap going on in the Middle East, everything else that you can add on, Washington, you name it. So it's not a good time for the risk adverse. But there are big profits to be made when the volatility is high like this if you're on the right side of the trade. So I'll keep doing these updates and giving you my thoughts, and if and as I change, that's it. So Amazon. Amazon did, by the way, took out that 123. Remember, I had two purple lines on Amazon, 123, which to me was pretty significant support, and the 200-day exponential moving average. It's taken that out. So that's bearish. But as I said the other day, just below those are some next key supports where the buyers may step in. And if they don't, man, if we just go on down through these levels like they're not even there, like a hot knife through butter, let's get out of Dodge time for the market. All right. And that's it. Oh, and that's not it. NVIDIA, obviously one of the big Mag 7, right at my purple line at 403.30. With the next this is lights out numbers, 375, and the primary bull market uptrend line off the October lows. And you have right there the 200, if you can see them in the video, both the 200 exponential and simple moving average. So this is massive support. And I'll be honest, support I think is going to get taken out sooner than later. To me, again, it's just a matter of, do we bounce first? Bounce will be enough of a bounce that you won't want to ride it out short, and you will want to ride it out long. That's kind of where at this very moment I'm leaning. And I was leaning that way yesterday into the close, but I'm not liking the fact of the how much a lot of these stocks are down again today. That doesn't really you can hear my voice. I'm cautiously bullish and ready to flip, and still leaving swing shorts on and in my accounts and longer term accounts. Those I've hedged up some of those. Oh, let me show you that, and then I'll wrap this video up. But there's Meta still. That purple line on Meta, I've had it there for a while. I'm not super strong on it. I still maintain these targets, but you can see what happened to Meta there. Tesla already rolled over after earnings. The last thing I wanted to give you is what was it, earlier this week? Or was it late last week? I mentioned Treasury bonds as long, and I give you TLT and ZB. ZB is a 30-year bond. You can also use the 10-year bond, which is IEF if you use ETFs, or ZN for Treasury futures. But there we got the breakout, and it's been moving higher. Nothing big so far, but it still has nice divergence. I think the RR right now in bonds is favorable. And I also, as I did, remember a few weeks back, I shared that I took positions in treasuries. It might have been the 10-year at that time. I can't remember, either the 10 or 30. Those are the ones I usually trade. I took them as both a pure play on the technicals, might have been back here, as well as a hedge to my short positions on the equity markets at the time, with the thought being, if treasuries rally, that means yields are going down. Right now, what we can see here is if we get a market crash, let's just say that comes. And again, I'm thinking that's going to be postponed for a little bit. When the market might want to see what Apple's selling, what Amazon's selling tonight. But if it comes soon, and it could come today, tomorrow, next week, next month, based on where we are with Treasury yields now, I expected this lift up in yields, which was a drop in Treasury bond prices. I think we can see a big shift, institutions selling stocks and moving into Treasuries for a flight to safety bid. Nobody's been wanting to buy Treasuries for a while now. No kidding, because Fed went from quantitative easing to quantitative tightening. So they weren't the big buyer of Treasuries; they were a net seller, and so institutions and plus inflationary forces. But when you look at it again, I showed you a 60-minute chart. It just that's divergent low, and then the yields. Let me just show you yields. Remember, there's a potential here to get a decent reversal. And I look at the weekly chart of TNX. That's the 10-year. Treasury yield, you've got divergences forming, and you're just above this primary uptrend line. Remember, these are the yields. They go opposite to bond prices. This is the 10-year yield. When the yield goes up, the prices go down. And so if yields break, if the trend line breaks on the 10-year, we're probably going to see the 10-year bond rally. That's IEF or ZN you can buy. And I'm going to put another level here because I can see a potential pullback target all the way down to here. And that would be a pretty nice move. Here, let me flip it upside down for you so you can see it through bull goggles and not bear goggles. So you buy the bond if you think the yields are going to drop, and you do it here. IEF, this is a weekly chart, by the way, weekly candles. And so there it is. It's set up, positive divergence. And so one of two things really, guys, can happen here. I've said this before. Bonds can rally from both a flight to safety. If all of a sudden the stock market craps out, and just like it used to be in the old days, institutions flock to safety, to Treasury bonds for safety, that buying pressure causes bond prices to go up and yields to fall. The other thing, too, is maybe there's a natural abatement. It's not a panic move into bonds, but all of a sudden just natural market forces start to bring rates down, and bonds go up, then that would also be, should be net bullish for the stock market. But either way, right now I'm treating them as two distinct trades. So you can buy bonds on their own merits right now, or their own technicals. Which, like I said, there's the IEF, the 10-year. It's not really doing much, but you've got the divergence, and the thing too, and even for IRA monies, we've had a big lift in yields. How much more are they going to go? If they continue up at the rate they're going, the stock market's just going to crash, and then you're going to make a lot of money shorting stocks. So I think that for the time being, the risk reward on Treasury bonds is pretty favorable. In other words, I think yields don't have that much more to go in the near term. I still remain very, very much longer term bullish on rates, which means bearish on bond prices. But I think more in the near term, intermediate, I think bonds, even maybe for 401k, time to maybe move some money back in. Because remember, even if they don't go up and they just stay at these levels right now, because the economy can't absorb much higher rates. The federal government can't absorb it. So something's going to have to give, or everything breaks. So even if the 10-year and the 30-year just trade sideways for a while, remember, you get paid. You're getting paid, what is it? I don't know, 5%, whatever the interest is on the 5-year or 10-year. I don't know, the yield, whatever that is. So just keep that in mind. That's a potential trade idea for you, in a way to asset allocation as well. Don't put all your eggs in one basket. So I'm going to stop talking now. All right, the levels to watch. Like I said, the market's at some key, quite a few stocks and the market are at key support levels, both price and moving average. Price action's pretty lousy right now. So we'll see how we end the day, and of course then we'll see how Amazon what that does to the market tonight, and if I can think anything else, I'll get it out to you, but this is really what I'm focused on right now. All right, this has been Randy Finney with Right Side of the Chart. Have a great day.